Stock buybacks are often hailed as a sign of confidence. But the evidence tells a different story. Many buybacks happen at market peaks, funded by borrowed money, and they can destroy long-term value. Examines the research and the mechanisms behind this counterintuitive reality. The common belief is that when a company buys back its own stock, management is signaling that the shares are undervalued. The logic seems simple: if insiders are buying, they must know something. But academic research and real-world cases reveal a more complex picture. Buybacks are often driven by incentives that have little to do with true value. To understand why management might buy back shares even when the stock is expensive, we need to look at earnings per share, or EPS. EPS is net income divided by the number of shares outstanding. When a company repurchases shares, the denominator shrinks, so EPS rises even if net income stays flat. Since many executive compensation plans are tied to EPS targets, a buyback can help management hit those targets without actually improving the business. A landmark study by Almeida, Foss, and Cronlund, published in 2016, examined buyback behavior among U.S. companies from 1988 to 2012. The researchers found that companies are more likely to repurchase shares when their stock is overvalued, not undervalued. Why? Because when the stock is high, the EPS dilution from issuing new shares is minimal, making it easier to hit EPS-based compensation targets. Conversely, when the stock is cheap, companies often hold back, conserving cash for uncertain times. Another troubling trend is the use of debt to finance buybacks. From 2018 to 2022, U.S. corporations issued over $2 trillion in bonds, and a significant portion of that went toward repurchasing shares. The formula here is simple: a company borrows money, then uses that cash to buy its own stock. This increases financial leverage, meaning the company takes on more risk. If the stock price falls, the company still has to repay the debt, which can strain its balance sheet. Not all buybacks are created equal. A sustainable buyback uses free cash flow, money left over after operating expenses and capital expenditures, to repurchase shares when the stock is reasonably priced. This can be a tax-efficient way to return capital to shareholders. In contrast, a debt-funded buyback at a high valuation is a red flag. It signals that management is prioritizing short-term stock price over long-term financial health. This chart shows the scale of corporate bond issuance from 2018 to 2022, which exceeded $2 trillion. While not all of this was used for buybacks, a substantial portion was. The trend highlights how easy it was for companies to access cheap debt, which they often use to repurchase shares rather than invest in growth or pay down existing obligations. The incentives are clear. Executive compensation often includes stock options or bonuses tied to EPS growth. By reducing the share count, a buyback can boost EPS and trigger these payouts. Additionally, management may feel pressure from activist investors to return cash to shareholders. But this short-term focus can come at the expense of long-term investments in research, development, or employee training. When a company borrows to buy back stock, it incurs interest expenses. This reduces net income, which can offset the EPS boost from the buyback. The net effect on shareholder value depends on whether the return on the buyback exceeds the cost of debt. If the stock price doesn't rise enough, the company ends up worse off. To evaluate a buyback, investors should monitor several key metrics. First, the price-to-earnings ratio, or P/E, tells you if the stock is expensive relative to earnings. Second, the debt-to-equity ratio shows how much leverage the company is taking on. Third, free cash flow indicates whether the company can afford the buyback without borrowing. Finally, the buyback yield, the amount spent on buybacks divided by market capitalization, shows the intensity of repurchases. The company is buying back stock. That's bullish, right? Not necessarily. Check if they're using debt. They just issued bonds. How does that affect the buyback? It increases leverage. If earnings don't grow, the interest costs could hurt. So should I sell? Look at the P/E and debt levels. If the stock is expensive and debt is rising, be cautious. Buybacks are a double-edged sword. They can be a tool for returning value to shareholders when used wisely, but they can also be a mask for weak operational performance or a way to enrich management at the expense of long-term health. As an investor, always ask, is this buyback funded by cash flow or debt? Is the stock undervalued or overvalued? What is management's incentive? By answering these questions, you can separate value-creating buybacks from value-destroying ones. We'll continue to bring you evidence-based insights into the world of finance. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.